Now, when we look at various business ownerships, I mean, structures about owning a business and running it, and it's like life stages. There are business stages, and you might want to have structures suiting those stages. By the time you start your business, you're clearly focusing on getting it off the shelf, getting it on the road and starting it. So the focus is not really on the structure and the optimal structuring. So what most families do is at most kind of engage with a CA and say, I want to start this business. What do you think is the best way to structure it? It's not a real detailed kind of conversation that's there. And that's where one needs to pay a little more attention. When you reach the growth phase, obviously you need a structure which kind of suits the trajectory of the business. There are factors to be considered when you have a growing business, and all structures might not suit it. And hence, one needs to be careful about having the right structure once you start out of the business, because two things happen. One is, of course, the value of the business grows, which means changing structures come with a embedded cost. And second is even your engagement with all your constituents might change if you have to change the structure. So you need to be very careful about at what time you're revisiting your structure. Best is when you start the business though. And you made a mention, Ruchika, of how do you kind of deal with it post-COVID. Now, I don't think structure will be determined by COVID or pre or post COVID. The structures would remain the same. It's just that we feel that in this environment, you're going to see a lot more of transactions happening for good and bad reasons. And hence, it might make sense to pay attention to how are we structured now, and is there something that we can do today to kind of make our path more efficient, whichever ways we want to go. Now, of course, the core is all this is created for creating wealth for self and for the family. So in what form are you going to kind of make it efficient to ensure that succession of business is also dealt with very efficiently? Like in exit of business, when you have change of shareholders and stakeholders, even when you have succession of business, clearly you're going to have change in control and change in ownership. And that needs to be kind of given attention to. Now, typically, families and entrepreneurs, our advice is always to have your assets demarcated, even when you start your business. The basic rule, I mean, whenever you have a startup business, is to say at least have 10 months or 12 months of expenses in your bank so that you can burn all the cash on setting up the business, but don't kind of burn the last penny on the business. But our recommendation is keep business assets independent of personal assets, and family members benefit from personal assets and not from business assets. This becomes very important because business is, I mean, whenever you have business risk, which gives you reward. And those risks should not spill over to your personal assets, because then whatever shelter need that you've created for yourself is lost. So hence our recommendation is always keep businesses separate from personal, and family members benefit only from personal assets. And that's the way we can look at structuring as well. Now, if you look at types of entities that people consider, I mean, this might seem slightly theoretical, but one has to live with it, because these are the structures that are in vogue in the regulatory world that we live in. The most basic type of business that even today people follow is having a sole proprietorship. As in, you don't need anything, you just start up your business and start invoicing in your brand name or in your own personal name. That's the easiest startup, no compliance. You pay your personal taxes and go on with life. The next level is when you set up a partnership, when you feel that there is one more person that you can trust, or a couple of more people that you can trust to be partners, you bring them on as partners. And this again is not so structured because the regulatory oversight is quite limited. It's not very heavy and it's quite tax efficient. But of course, it has its limitation in terms of engagement with other stakeholders. But families love this structure. So if you go to any traditional family, there'll be only either sole proprietorship or partnerships. The reason that people have migrated in the past to company structures, which could be private limited companies and thereon to listed company, is a very basic reason. Banks said we can lend more money to limited companies. I mean, it's a reason which doesn't kind of stand to any logic, because for banks, partnership is as good as a company. But yet, banks prefer companies because you have shareholders, and if there's a risk coming on, you can go after directors and then the shareholders. Whereas in a partnership, though the risk is higher for the partners, the banks feel more comfortable if they have shareholding of the company. One of the structures that has come into vogue in the last 8-10 years is limited liability partnership, which is actually a blend of both partnership and company. It has the benefits of partnership and yet has the corporate regulatory framework of a company. The key thing here is a partner can come in and he has limited liability limited to their contribution to the business. So it makes it that much more simpler to deal with, and hence some families look at limited liability partnership as well. Now, of these structures, which would suit which family or business is obviously a matter of discussion, but we try and address as to how you can decide which structure is best for you. Now, in terms of key attributes of structures, clearly, I mean, if you look at it, right from registration to a number of partners, proprietorship is the easiest, right? But it has its limitation. You can't get shareholders in, which means you can't get further capital in. Banks might look at it with suspicion. There is taxation is quite inefficient, but yes, proprietorship is the easiest. Then you go on to partnership. It need not be registered with regulators. It's optional to get it registered. And why do you get it registered? Because you get that much more of legal sanctity when you get a firm registered with the registrar of firms. It's not mandatory. And the other parts of partnership would be, I mean, it's very easy to manage. Control is family members together or friends and relatives together running a business. So it's very closed group which is operating the business. In terms of liability, both in proprietorship and partnership, the operator of the business has absolute liability. There's no limitation. So their personal liabilities are straight at risk if anything goes wrong with the business. There's no shield protecting them if, God forbid, business goes wrong for some reason or the other. And in times like these, those conversations are very relevant, because when you're struck with cash flow issues, when sales is not happening, inventory is piled up, how is it that you're going to kind of ensure that you pay up to the bank if you've taken a line? You do have moratorium out there, but moratorium doesn't mean that waivers are coming in. You have to pay interest on interest and the principal as well. So these two structures need to be a little careful in terms of how they deal with their liability, how do they ring fence their personal assets. Like I said, regulatory reporting is very minimal in both the cases. In partners, you just need 2 people. You can go to up to a maximum of 20. The right side is more about more regulated environment of operating business. And hence, obviously, more compliances come in, more cost of compliance as well comes in. Both have to be mandatorily registered. You can't just, can I take the questions at the Q&A session? I can see your hand raised, but I'll take it after the presentation is over. Thank you. So both are very regulatorily governed, hence that much more of cost would be there in terms of managing it, but I don't think it is onerous. The benefits of having a regulated structures far outstrips the cost that you might incur in running them. Ease of management, it's more controlled. So if I'm a shareholder wanting to deal with a company or LLP, I feel that much more comfortable because there are governance systems which are built in. Liability can be limited in both entities. So wherever you're looking at controlling liability, as a shareholder, you don't have that much liability. You have more liability as maybe a partner in an unlimited partnership or sole proprietor. There is, in terms of number of people, obviously, a public limited company has no limit, where you have public at large as shareholders. In a private limited company, there's a limit of 50 members that you can have. Now, this is the key. Business needs funding. Whether it's shareholders or banks, you need funding. So where is it that people are feeling more comfortable to put their money in? Clearly, it's difficult in a proprietorship and partnership. It's more driven by the relationship that one has with the bankers and institutions. It's not to do with the business. Business funding is there. One can see the business risk and start funding. But if you look at it, most of the traditional bankers will say, Saab, aap hain to hum denge. That's the approach they take, right? Whereas in a company in LLP, since it's more regulated, institutions feel more comfortable dealing with them. In our experience, when you're looking at shareholders like PEs and VCs, they've been a little nervous with LLP, more comfortable with company structure. So any business which is graduating towards getting equity funding might have to move towards company ownership and not have partnerships or sole proprietorship. Taxation is something that which is often discussed And many a times, sadly, that determines the structure, sometimes determines the business model as well. In our mind, taxation is there only if you have profits and if you have a viable business. So I would look at what's a viable business, generate profitability, and then look at the appropriate structure. But of course, lately, there's been a lot of incentive for private limited companies itself in terms of taxation. But one needs to pay attention that these rates that are shown here, when you want to take money out of the business, you're going to be suffering dividend distribution tax. So that's another 20%. So if you're looking at tax optimization, maybe partnership is the most efficient. But having said that, you need to look at what is better for the larger business. Uh, some businesses would have need to expand overseas, set up branches, set up offshore subsidiaries. Now, clearly, all four, you can certainly go out and set up businesses outside. But yet, if you're kind of looking at expanding, then a company structure might work better or a LLP might work better because stakeholders are more comfortable with a regulated entity. But having said that, there is no restriction in terms of money being remitted from the business overseas for expansion purposes. Normally, it's 4 times net worth that can go out. So whatever is your net worth in your business here, 4 times of that can go out. Cost and expenses, like I said, for me, it's not really a relevant discussion. I would rather look at what is good for the business than be cowed down by the costs coming in. Now, which structure do I choose? I mean, how do I go forward? Now, key factors to consider before you decide, of course, is whether you have a single division or a multiple division business, whether they are working together, they're complementing each other, or they are independent businesses. So if you are independent businesses, maybe to de-risk, better to have independent companies with a holdco structure sitting on top. In terms of ownership as well, one of the factors that you need to consider is whether you're having direct ownership or you're having layered ownership. If you look at traditional businesses, they'll have this web-based ownership where you wouldn't know who's owning what. Uh, in my mind, simplicity of ownership is the best way to go forward in business, because a businessman is better running his business than managing structures. So create a simple structure and focus on the business is what I would say. One also needs to consider whether what how are you going to kind of fund the business, whether you're looking at equity or debt, and then suitably look at a structure which will appeal to constituents who are going to support us with financing. Like I said earlier, whether you have domestic or it's going to be offshore as well will determine a efficient structure. Risk profile is important from a business perspective in terms of, obviously every business has a risk, but certain businesses have a better, higher risk. So in that situation, do you want to kind of keep that separately so that your other businesses don't impact it? Is something you need to consider. Lately, in the last 10 years, I mean, we've seen host of companies wanting to reward the employees as being participants of business. So again, there, if you want them to be given stakes in companies, you need a company structure. LLP doesn't work very efficiently there. And also, how much of regulatory licensing engagement do you want? That can also determine a structure. So I would say it's not one fit all. You need to sit with each family and determine what's the best. But you need to keep all this in mind when you're kind of going forward and setting up structures. Now, clearly, expansion would mean that you need to be transaction ready. Is your structure transaction ready? You just need to look at it from a perspective that if you were to enter someone else's business, what is the structure that will give you comfort? Clearly, ownership should be simple, clarity of business should be there, and it should be easy to kind of navigate. And that's something that a comfort should be given to the new stakeholder to say that they can come in or you can kind of proceed and acquire some of the business. Now, in terms of approach of families vis-a-vis business, I'll just take another 3 or 4 minutes, is when you're having businesses, clearly have business issues independent of family issues. Never mix them both. If you mix them, disaster striking. Because the risk that you might take in business, you can never take in family, and vice versa. So from a family perspective, whether you want to own the business or you want professionals to manage the business. In terms of strategy and vision, have clarity in that. If you're running it, ensure that your lineal descendants also have it. If you're not, share it with your professional management. Business succession is a key. We've all seen recently the Hinduja case that came up where there are challenges in terms of how succession is going to be dealt with. I believe that you just sit back and figure out how you want to deal with your succession. It's easily kind of managed. What is important is giving clarity to successors more than ownership. Ownership can follow, but give clarity. If there's no clarity, then there is always confusion. Um, and of course, whether you have next gen coming with you or you want to invite them is something that you need to look at. Business related issues in terms of risk management would obviously be compliance risk with ROC or SEBI, creditors risk. Am I over leveraged? Am I risking my business because I'm over leveraged? The regulatory risk in terms of complying with compliances, that's very important because you need the right people dealing with the regulatory risk. And business risk is something that every entrepreneur understands. I don't think anyone needs to teach them that. That's something that most comfortable with. The other three risks is something that people need to kind of imbibe and be comfortable with. Now, if you don't plan, obviously you can have business splits. If you have the wrong partner in a partnership or shareholder, hostile acquisitions can happen. There can be legal battles for inheritance, uncertainties for employees, investors, because whenever there's ownership, lack of clarity, the others step in and create confusion. You're exposing personal assets to business risk if you don't keep them separate. There can be additional tax leakages as well. Like I said, in a private limited company, the tax rate might be lower, but the cost of taking money out of the business is certainly higher. Um, I'm happy to take on questions now. I've got a couple of other slides, but one slide that I might want to spend time on is if one is considering, let's say, family trust to hold ownership of businesses, which is what large families have done, whether it's the GMR Group or the Godrej Group or the Burman Group. How is it that you would do it? Clearly, you will have business assets held in a separate trust, and then personal assets come in. The reason for considering a family trust is because it gives you protection from most of the liabilities that you might have as a business person. And that's why you might consider a family trust. So I just thought I'll touch upon it. Now, happy to take on questions as they come along.
Hi, Girish. Sorry, I was not there to welcome you. There's some connectivity issues because of the rains today.
No problem.
I'm so sorry about that. I will help you to take these questions if that's okay.
Sure.
So somebody, I think when you were talking about ROC and ROF wanted to know what exactly it is. So if you can define that for them, please.
So registrar of companies and registrars of firms is the regulatory authority where you register companies, and firms you register with the registrar of firms. Now, in some states, you might not have a registrar of firms. You go to the same sub-registrar where you register your real estate property and register your firm.
Okay. The next question is from Manoj Rajan. He says, even for normal ESOP, do you need a trust structure?
So one is, of course, if you want an ESOP, the basic idea is to share wealth with employees, right? And many companies have felt a trust structure works because you have an employee trust, which kind of has a very transparent mechanism of holding shares and then giving them to employees to be vested over a period of time. So it works very efficiently. Having a employee trust certainly works very efficiently.
There are a few questions. I'll request at this point of time to for the participants to keep posting their questions.
Sure.
But there's some questions which came in advance, Girish. I'd like to
Sure.
route that to you.
Yeah.
Just a second. Ruchika, can you go on mute? I think there's disturbance behind you. Just a second. The question is practical structuring of business rather than theory for MSMEs is what they wanted to know from you. So any practical structuring that you would want to say in points for them?
Yeah, so some of the pointers that I addressed while presenting should cover that. But having said that, the basic thing is you need to be clear next 10 years whether you have enough capital and sources of funds to run the business yourself. If you have, then you would obviously go for a tax efficient optimal structure, which will save you a lot of money. But the moment you want to invite money from other stakeholders, be it a bank or investors, you might need to step into the domain of private limited companies and listed companies. The difference between private limited company and listed company is in a private limited company, you're inviting only private shareholders. It's not public at large. The moment you go get listed, you're inviting public shareholders at large to participate in your business. And the issues that might come up and the benefits. Issues, of course, is you have many more shareholders around the table who can question you on the way you run your business. And the good part is you're to that extent de-risked, because if I run a business, let's say I have two shareholders and then I invite another three shareholders, clearly they can have some bit of control over my behavior and over my business, the way I run it. Whereas if I have a listed company where there are way more shareholders, building a consensus is that much more, maybe easier. I mean, it's subjective, there's no right answer to it, but you always feel more comfortable if you have more shareholders when you're kind of you don't want to deal with select few shareholders,
Right.
and you want to de-risk your business model.
The next question was, again, I think you've kind of answered it, but the next question was, can you throw some light on public limited structures, especially for SMEs?
Public limited companies, uh, right? I mean, it's the same. I mean, when you are having a company, you can have a private limited company, you can have a public limited company, you can have a listed entity. I think the question is more directed towards listed company, and obviously there have been developments there in terms of enabling SMEs also to get listed with exchanges to access capital markets. Otherwise, the feeling was always that you had to be a large enterprise to go to the public and raise money. So that's where I mean, obviously the government took the initiative about 10 years back to welcome these SMEs also into a platform like NSE where they can get listed. And but the limitations, of course, is that it has scale limitations, and you need to be very sure if you're an SME whether you really want to go public. The reason that people are considering going public was, again, I mean, something that doesn't appeal to me, is to say that listed company shares more tax efficient, zero taxation, so let me go and get listed. Those days are gone. So I think the reality is, whenever you're looking at a structure, look at what is right for the business and then look at what is tax optimal rather than the other way around, because we are coming across whole number of families which have created structures and ownership patterns both in the personal and public space. For tax reasons they were created, and you'll have a family having 50 entities just because someone 20 years back said that many more files, that many more exemptions, right?
Right.
Those days are gone. Now it's the time of simplicity where you want to kind of crunch structures, make it simpler and also easier to manage. Just imagine that if I have 50 entities, how is my successor even going to understand what I own? Whereas if I have one entity, they know whether it's good or bad and whether what they own. It makes it very simpler. So I think lately in the last 5 years, we've seen a definite move over simplifying structures and having very small structures.
Sure. Structuring for family businesses, should we diversify? That's another question.
I think the question would be, should we diversify business? Or I don't think it can be towards diversification of structure. I think it's. I'll take it in two parts. One is to say, if you have multiple businesses, what could be a good structure? If you have multiple divisions, what could be a good structure? And then look at people and whether you want to diversify people running separate businesses or not. Because in families, various combination can come in. Now, when you have multiple divisions, like I said during the course of my presentation, you need to see whether they are interlinked and part of the same business. If they're part of the same business, unless there are regulatory issues like licensing issues, it might make sense to keep them in the same business. Because end of the day, one of them would be input provider and one of them would be output creator, right? So many a times you might say that raw materials I'll warehouse in a separate business, manufacturing in a separate business, and distribution in a separate business. I think it's a call that one needs to take. If the benefits are not far outstripping the limitations, you should stick to a simple structure. When you have different businesses, the answer is different. So if I have, let's say, a newsprint business, aviation business, a medical business, I might want to have separate entities for them from various perspectives. One is because each business carries a defined risk. So any stakeholder that wants to participate in that business clearly understands that it's got Chinese walls, it's a separate entity. The risk that comes with the business is clearly identified, and hence I can participate in that risk. I feel comfortable with it. So in those kind of situations, you might want to have separate entities. The
Sure.
third reason that you might look at having multiple structures is geographical spread uh, within the country and outside the country. Many a times people feel that if they have branches across states, they might have separate entities operating them. And the reason given is at times you have a separate distributor there who's a sales function. He wants to be a stakeholder, so set up a business for them. Motivating a sales force can be independent of business structures. You need not have a separate company because that's a separate cost, separate compliance, separate management. So hence I would say that as long as geography is within a country, it might be simpler to have a smaller structure unless you're forced into having multiple structures. When you're having geographically different locations, which could be different jurisdictions, let's say I have a business which needs to do manufacture or distribution across geographies, across continents, then you're governed by regulations there apart from your own desire as well. So the government here does provide for you having a wholly owned subsidiary, but you might need a separate entity rather than a branch. So then it's more regulatorily defined than business defined. The last part is when you have multiple branches of family members operating businesses. Do you keep them all in one entity or do you keep them all in separate entities? One of the examples is, I mean, you can see Haldirams, for instance. I don't know why I keep taking up that example, but that's top of the mind. They do have three different entities. Family at large might be one, but different branches. They have segregated their geographies and operating independently. One, it ensures peace within the family. Succession is very clear and also ensures that as a brand, you're covering a larger space. So it's something that amicably, if it is sorted, it's brilliant, but otherwise it can become an issue. And you do have a whole lot of families which, because of um, different branches within the same family, might have different entities operating. You need to there be very, very clear on ownership, succession of ownership, the governance of those entities, so that future generations never have an issue in terms of dealing with their entities, because you don't want structures creating future litigations. That's expensive, doesn't make sense.
Right. Okay. Just one more question from Manoj Rajan. Have you seen startups start off as LLP or proprietorship, pitch for equity, and then before funding convert to private limited, maybe in 10 to 12 months? Have you come across something like that?
Yeah, so obviously, I mean, like I said, when you start up, the business idea far outstrips the logic of having the right structure, the right funding mechanism. So you want to execute the business idea as soon as possible. So we have seen sole proprietorship, but that's very marginal. So lately, if you see, most of the startups are from people who have either already worked, or like people in the audience, in organizations, or are well aware of the merits of looking at structures upfront. So I would say most of them, because they would have a CA who would have a chat with them and say, don't start off as a sole proprietorship. It is simple, but yet if you're inviting stakeholders, maybe look at some different structure. So yes, we have seen businesses start off as LLPs or partnership and then migrate to a private limited company. One needs to understand that every shift in ownership or structure can come with a cost. So though you might say that partnership today comes with a lower cost in terms of taxation, easier management, lesser compliance, if you foresee having shareholders in your business, maybe private limited company might be a better idea upfront, because though some people might say the tax cost is huge, you need to look at what is the value uptick you're going to get in the business. The value uptick is far outstripping the tax cost, then why worry? And if you're worried about valuation, then you might not be in the business itself, right? Because you're not a risk taker. So I would say that's, and that's why I said that if you're very clear that you don't need funding from other shareholders and you're very clear you can manage all of it, or with banks, LLP might be a good starting point. And after 10 years, even if it's going to be expensive to convert, you're doing it for a reason. You're doing it to monetize. your asset, or you're doing it to monetize the business, right? And at that point of time, the value will far outstrip the tax cost. And we've seen those conversions happen from partnership to private limited companies.
Sure. We'll take more. We can also take audio questions now. Na Ruchika, if we have any, somebody raise their hands. Has somebody raised their hand?
As of now, nobody.
Okay, so I have an other question from Haren Sangvi. I will urge people to start posting their questions and also raise their hand if they have an audio question for Girish. Right now, a question from Haren Sangvi. You said at some place family businesses should be able to handled more professionally. Please, can you be more detailed on it?
Yeah, I said that families need to be clear whether owners are going to operate the business or they would want professionals to operate the business. And that becomes a key issue because it all brings together a whole lot of issues that need to be dealt with. One is, if the family is very clear that for generations they're going to operate the business, they need to give absolute clarity to family members in terms of how ownership is going to kind of pass on to the next generation. And that's where maybe family trust come in. So you've seen family trust happening a lot in the last 5-7 years. Some people might say it's to kind of mitigate against risks, one of them being potential estate duty or credit risk. But the real reason is that when I have ownership consolidated, you don't need to worry about passing on ownership. You just pass on benefits to family members. So family trusts are used in that manner. Now, if you very clear that you want to, over a period of time, professionalize the management of business. So in your mind itself, you need to start letting go. And what better a forum than ASCENT, because this is the genesis of ASCENT, right? In terms of the person who set it up was a pioneer in letting go rather than holding on. And that's what makes a migration to professional management that much more seamless. So I think if you ask me, it's more in the mind of the promoter to say that I need to get professional management to run this business. I need to let go of the powers that I hold close to my heart and chest and let people take decisions, but backing them up right through. Not to say that you take the decisions and you bear the brunt of it. I'm there to kind of support you. And that's the kind of approach that promoters need to have when they're migrating from, let's say, ownership driven business to professionally managed business. I hope I answered the question.
Right. Haren, if that's a question if that's answered, you can, have a counter question if you have. Otherwise, we'll move ahead. Ruchika, raise your hand. Any questions? Oh, no, Haren has just said thank you. So I think that question is sorted.
Okay.
Another question is there any tax implication to convert from LLP to private limited? Is it difficult to do this?
Okay. Nikhil, you want to take that question? I got my colleague Nikhil also there.
Yeah, and a little bit more if Nikhil can elaborate more on the taxation implication around this.
Sure.
Not just this question, a little more about taxation.
Absolutely.
Nikhil, go ahead.
Sure. Can everyone see me?
Yeah.
Yeah, perfect. So conversion of company to LLP is possible, but there are conditions associated. Three main conditions being the asset criteria, that is 5 crores, and turnover being 60 lakhs. So if your business, or rather the company today, has a turnover which is more than 60 lakhs and an asset of more than 5 crores, then the conversion becomes a taxable event under the Income Tax Act. And if you don't meet in these, as in if the criteria, or rather your thresholds don't cross, then potentially you could look at converting from a company to an LLP, and there should not be any tax implication as such, because it's clearly provided by law. And that essentially gives you the advantage of now, from a company standpoint, now you would have ideally want to distribute dividend. You would have had dividend distribution in the hands of the shareholders at 30% today, which in an LLP standpoint, you would have not had this additional tax in the hands of the partners. And that's an advantage that you get. While we did touch upon the tax, criteria for conversion, there are ways and means in terms of, creative ways of looking at options, but we need to look at GAR, which is the general anti-avoidance rules in mind before we look at any other creative structures to achieve a LLP structure.
Nikhil, if you can also touch upon conversion of a LLP to a company. uh, you've done the reverse, which is for tax optimization. But what happens if I convert a LLP to a company?
The LLP Act today does not clearly provide for a mechanism for a conversion, and therefore the conversion aspect has to be looked at a little differently in terms of whether you move the business lock, stock, barrel into a newly formed company or something on those lines, which again, depending on the cost and the values involved, you'll have a tax implication as capital gains in the hands of the LLP.
So usually it can be an asset transfer or a slump sale of a business which happens. So it is treated as a transfer of asset when you
Correct.
move from a LLP to a company.
Correct. There is a provision under the Income Tax Act which says succession of business, where you could still try and take more to say that it is not a conversion, or rather not a transfer. But again, we need to look at facts to see whether it works, whether it meets the criteria or not.
So we have an audio question from Mahesh Ahuja, and there is another question on tax. So I'll come back to that. If Mahesh, can we give access to Mahesh Ahuja, Ruchika, for him to ask an audio question, please?
Hello, can you hear me?
Yes, go ahead, Mahesh.
Yeah, anyways, I was just typing it. So basically, we have a proprietorship for company in our portfolio, and we wanted to convert it to private limited because we're hiring some talent, and we need to kind of give some stake. So can this be done without any tax implications if all assets and liabilities are transferred to the new private limited company, or do we need to set up a separate companies because obviously it's not tax efficient otherwise?
Yeah, Nikhil, you want to take that?
Sure. No, there again, unfortunately, even for conversion of proprietary to company, also there's no set rules set out. Of course, you can look at options of saying it's only a vesting of assets into the company, and therefore, look at taking an aggressive view to say there should not be any tax. But again, if you go back to from a value perspective, you're able to contribute and create everything as a capital in the company. Probably there's a way out. Again, it's a mix of if there's an increase in value, obviously you'll run a taxation risk.
So just to kind of elaborate on what Nikhil said, whenever you have a company and you're contributing anything as capital, that's a tax-free event. Whenever there's a shift of asset from one entity to another, it can be a taxable event. So being a sole proprietorship, we need to kind of look at facts and examine as to how to make it tax efficient. But I'm sure you need to look at from a long-term perspective. Now it's the employees, but later on it could be other stakeholders as well coming in. So there could be a cost, if at all, but you need to look at the larger perspective and decide to move to a PLC, because in the long run, if you're looking at business expansion with external capital and debt, a PLC works better.
Okay.
Mahesh, does that answer your question?
Yes, it does. What if I just have a slight more clarification?
Yeah.
Sure.
In case this company doesn't have any assets per se, but has a large turnover, so obviously there's capital. So this proprietor puts in that capital. There is a way out. You're saying we don't have any assets as such.
Just to pick that point, and in that, I'm not getting into advisory mode here, but that said, if there are no assets, I'm presuming it's more of a service related
service company. Yes.
Yeah, so you could do a partial migration wherein you could start new contracts at the company level, and as and when the contracts are up for renewal, you can come look at it at the new renewal at the company level, and therefore slowly migrate the business into the new entity.
That would be easier, right?
That would be much easier.
So migration of business transactions can happen. Migration of capital required for business can be going through capital. Okay. So that's how you can make it tax efficient. Don't show it as a from a structure perspective. We're not saying we're converting from sole proprietorship to private limited company.
Yeah.
But the message is that you're going to start business in a private limited company. Then it becomes easier. Okay. But if you're saying you're converting, then it becomes complicated.
Okay. Then it's subject to interpretation.
Absolutely.
Okay. Thank you very much. Thank you.
Thank you, Mahesh. More questions on tax implications, of course. Sanju Desai, in private limited company, is it advisable to give sweat equity or ESOP? If yes, which one is better for promoters?
So, I mean, obviously, this is a decision which is always a contentious one. When you say sweat equity, you're not paying for it. It comes for the sweat. Whereas when you give ESOP, there's capital going in. So there's a commercial leg to it that one needs to keep in mind. And promoter, of course, if he's operating the business with no other stakeholder, it's a call that they can take whether the company needs more capital or not, and move on. But if you're going to have other stakeholders, obviously the other stakeholders will have a voice in terms of how you're doing it, because one needs to see how they're going to get diluted, if at all, and those impacts need to be seen from a shareholder perspective. But otherwise, I would say it's a function of capital requirement, unless, Nikhil, you have some tax angle to it.
No, one other company law angle as well. Company law also talks about who can get an ESOP in the company, and promoters are not persons who can get an ESOP. Therefore, the way a sweat equity or a compensation that a promoter gets will be structured completely different. You would have heard of terms of MSOPs, which is more prominent in a startup phase. And that's something which is more something we need to explore than an ESOP. Again, it's more about how creatively you write your shareholders agreement.
Creative, yes. So next question is from Pratham Gandhi. What is the tax implication of a holding company for multiple operating entities? I was told that it results in double taxation.
No, not really. I mean, obviously, holding company, if it owns more than 50% in a subsidiary, I think the what they're talking about is in terms of dividends being upstreamed. Is there a double taxation impact? As long as your holding is more than 50%, there is no double taxation incident. I can't understand what other tax impact he could be talking about, but usually it's about upstreaming of dividends, and which is where some we've had cases where unfortunately they've had ownership of 49-48%, and there's a double dip in terms of taxation. You need to be careful in terms of how much you're owning of the subsidiary.
Question from an anonymous attendee. So is it easy to close an LLP?
Okay. No, so I'll take it in two parts. Obviously, Nikhil will step in. One is, of course, when you're saying closing, what does it mean? Are you shutting down your business, or are you saying that you're migrating a business to a different entity? Now, in terms of shutting down any entity, obviously you need to ensure that all stakeholders are taken care of, whether it's loan with banks or other creditors who are there, and then the partners are taken care of. But beyond that, it's about surrendering your entity, your identity with the regulatory authorities. So, Nikhil, you want to add something to it?
No, it is possible to wind down an LLP. If I'm not wrong, I think the procedure complexity is at least lesser compared to a company. That said, it's within ROC that the register of companies that you need to apply for a shutdown like you incorporate, and the procedure there has to be followed. But comparatively, when I say comparatively, it's almost similar to a company shutdown.
So maybe a partnership is easier, unlimited partnership.
Absolutely, absolutely.
Okay, the next question is from Ashwin Agarwal. Ours is a private limited company. Is the new tax structure applicable for our LLP as well? Is it advisable to convert the private limited to LLP?
Yeah, Nikhil, you want to take that?
Yeah.
So when you say the new tax structure, we're talking about the multiple rates. I'm presuming that's the question. And
yeah, for
those correct. So those are very specific for private limited companies and not for LLPs. LLPs are taxed at 30% plus a charge cess, which can go up to the peak rate will be 34.994%. And that is something which will be applicable for LLPs. I think that pretty much answers the point.
Yeah.
All the other benefits of 15, 22, 25 and 30% taxation, which different schemes available, are only for companies.
Okay. Another question, this is with regard to an LLP. When you file with ROC for closure and you get the intimation that the process will be done in 1 month, but if it is not closed even after 6 months, then what should be done?
Unfortunately, there's no straightforward answer here. If the closure, until a closure certificate or closure confirmation given by ROC, it's not closed, and therefore you need to follow up and get this done. There's no other option.
Yeah. And why do you
Only thing you need to see is why it is pending.
so long? Yeah. And why would you think any assumptions there? Why do you think it takes so much time?
No, so there could be multiple aspects, because sometimes if I have to give an example of a company wind down, it can get done in as simple as 6 months and can go on till 3-4 years, and I've practically seen such cases. It's all about what are the prior activities, what are the open cases. When I say cases, it's more from tax as well as regulatory, as well as from an ROC standpoint, what are the pending legal compliances that has not been done, what irregularities has to be regularized. Everything has to be made clean before you go in for a shutdown, and therefore those are the aspects which will kick in. And essentially, unless you correspond with the officers at the ROC to understand what is stopping them, you really don't have an option but to get those things closed before you go, those open items to be closed before the company shut down.
Okay, so I don't see any more questions here in the Q&A. If there's any audio question, we'd like to take it now. Haren has sent a thank you, but any audio questions, we can take it now, or you can have more questions posted here. No? Okay, so anything that you, Girish, you and Nikhil want to add before we wind up, because I think we're also on time.
Yeah, a couple of aspects. One is, of course, whenever you look at a structure for a business, like I said, initially, the business would drive the structure and not the tax considerations alone. And like you've seen in the questioning also, a lot of questions are driven by tax. It is a very critical aspect of cash flows and the way you manage it. But eventually, if business is creating value, which is a structure which best meets it. So that's something that we need to keep in mind. And in terms of business, obviously, this a host of entrepreneurs here would be first generation entrepreneurs. They need to look at what next. If, let's say, God forbid, something were to happen to them, and times like COVID, this kind of discussion becomes more relevant.
Right.
God forbid something were to happen, how are they managing with business continuity from a business operative perspective and from a management perspective as well?
Right.
Those things become very, very critical because from a management and ownership perspective, you need to have complete clarity in terms of how would you want business to, let's say, continue if someone were to drop dead, literally. It's not as if the business dies with the individual. Business is for multiple generations. And hence you need to kind of think through that and have a plan in place which factors that in. That becomes very, very important. And you need to express those wishes in no uncertain terms in terms of how is it that you want ownership to flow down multiple generations. The other aspect is in terms of operationally ensuring that there's no disruption. Obviously, I think most of the people would have seen, faced, and experienced disruption and continuity, the way you look at it through this period. And it's been a wake-up call for many, many businesses to say, how do you kind of ensure that business as usual continues in spite of the challenges? So I would say it's a good wake-up call to have, and it's not a bad thing. So for us to sit back and realize what better we could have done to ensure that business continuity is maintained without any disruption. So I think these are two aspects that one needs to look at. The third one that we always ask families to do is identify risks in business, which are controllable risks, and how do you want to mitigate those risks? Obviously, business risk is something that you need to have in a measured way, but the other risks that carry on because it's an integral part of the business could be credit. Bank money is available, but it's not free money. So beyond the level, don't go ahead and leverage and put at risk both the business and your personal wealth. We've seen families where their own houses have been put up on the block because they didn't think through the risk mitigation of their wealth. So I would say that is something that you need to do very, very carefully, which is what I mentioned a little bit in our presentation to say that if you're having ownership held by individuals and you're worried about succession of it, I know that you all have covered succession planning quite a bit in the past, but you need to look at business succession as well, apart from personal individual asset succession. And that becomes very critical. It's not that you just need to have nominations in place in your company or in your personal investments. You need to have papers like will or family arrangements or trust documents in place to ensure that it's seamlessly done. Because if, let's say, God forbid, there's a ownership of business, and most families that we come across, if 100% is their balance sheet size, the business ownership value would be 70-80%. So that's a value that you need to protect during lifetime and post lifetime. So if a competitor feels that patriarch is not there, now is the time to zone in and take over that business or kill that business. The family has to stand up and say that there's complete clarity in terms of succession. We are well organized. No one can touch our business. And that's the message that needs to go out strongly. And which is where you can either have consolidation of ownership through having a family trust owning the shares. And some of the largest businesses in the world are held by trust, family trusts. And what that does is when you have a trust, the ownership is always static. It never changes hand generation to generation for multiple generations. The benefits is what goes down. So the benefits goes to spouse, children, grandchildren, great-grandchildren. The fight about being a owner of a share is no longer there. And if you realize in the past, most of the fights are about that. So that goes out of the way completely. And that's something that I think families should look at very, very carefully, both in their business space and in the personal space. Because personal space, we come across many families who say that I've done my nomination, I've got my wife as a second holder, I got my child as a second holder, my planning is done. Unfortunately, that doesn't pass on ownership to the next person. It only passes on the power to hold assets, not own assets. So that's something that I'd urge every member who's there right now attending this seminar to pay attention to.
Thank you so much, Girish. Really a lot of insights, kind words, and wisdom through your talk today. Thank you so much. And of course, we're ever happy to collaborate with IFL, who has been a great supporter for ASCENT in the last 3 years. So thank you so much, Girish. And thank you, Nikhil, also to come in and answer all our questions. Thank you once again.
Thank you, Archana. Thank you, Ruchika.
Thank you. Thank you.
Thank you all. Thank you.
Bye-bye.
Bye-bye.